Hello, good morning, good afternoon, and greetings. This is the second episode, the second lesson, which I would basically call an extension of the first, because in this second lesson of essentially learning how to make ends meet with the markets, I will be extending an explanation of what liquidity is. And because of that, this hopefully will be a much shorter video, because I'll just be covering the sessions, the time based liquidity, and of course swing based liquidity we already know from our previous video, from our previous lesson. As a recap, we already know that this here is a swing high, which is buy side liquidity. We also know that this is a swing low, which is sell side liquidity. But the other concept, well, an extension of what this is basically is based on time. The first one is going to be a bit of a step up, but that's called the IPTA data range. IPTA as an IPDA, IPTA, and IPTA is basically the algorithm that's in charge of running the markets. So what it basically states is that liquidity that was made in the last 20 days, 40 days, and 60 days are critical and are important levels where the markets are probably going to try and seek to get. What does that mean? It means every month from the first of the month. For those that don't know, you can obviously see my dates down there and the times down there. You can see this is the 1st of May right here. This candlestick creates the 1st of May. Was created on the 1st of May. At this point, I use my vertical line to delineate the start of the month. From here, using the tools on TradingView, you can easily use a measuring tool to count backwards, or you can actually count it manually by hand, but obviously that's not efficient. So I would use this measuring tool, then using the shortcuts on my keyboard, I would count 20 bars to the right. We can see right now it's written 7 bars, 9 days, 8 bars, 9 bars, 10 bars, 11 bars, 12 bars, and I'll reach 20 bars right there. Then I'll use the shortcut key on my keyboard, which is Alt V, to delineate 20 days looking forward. From the same date on the 1st, you count backwards, so obviously it will be minus 20 bars. So that's where we get minus 20 bars there. We Alt V. If you don't use Alt V, you can obviously just pick your tool and draw it out. I don't know if you want to use a vertical line like I'm using, or a trend line, or don't even want to use a line, you just want to highlight the liquidity levels. That's also fine. That's all from preference, but this is how I do it personally. And then from there, since this is our ground zero, right, we counted back 20 bars. We're gonna count another 40 bars, which is basically adding 20 to it, and then we're going to count another 20 bars added to that, which is 60 to it at that point. So this is called the IPTA data range. The reason I draw this out is to basically allow me to identify where critical highs and critical lows are, and whether or not we are in premium or discount for the range, for the month, of course, and the range. And many might be asking what premium and discount means, but I'll try and cover that in this video. I will not fully break it down, but hopefully as I go through the series, you would be able to understand better what a range is and whether or not something is in premium or something is in discount. So the first thing we do, we already know how to identify the opening price and the highs and lows of a candle. I'll give you a second. Obviously I can't see what you're saying, but I'll give you a second to identify where the opening price is for this candle that was created on the 1st of May. Remember that 4 points in a candle. There's the high up there, there's the low down there, and then there are these two prices here, there and there. So identifying where the opening price is, considering that this is a bearish candle. Well, I'm hoping that you actually just chose here because this is as straightforward as that. But we opened up here, we traded higher, we traded lower, and then retraced and closed here. Opened up here, traded higher a little bit, traded lower, and then retraced and closed here. This did the same thing. We opened up here, we traded lower, we went high, and then closed here. So we actually closed higher than where we opened. So this is our open, that's our close. In this case, this is our opening price. So I draw the opening price out and I label it as my EQ. The reason I label it as EQ is to show me that that's the equilibrium. That's where we opened up in the month. Because when you look at the monthly time frame, you would notice that the EQ is basically the opening price of this monthly candle. So that's where we opened up in the month. So I'm just looking at it from a daily lens or a daily perspective right now. So if that's where we opened up, the next question would be, looking at the 20 days, 40 days, and 60 days region, are you able to identify the highest points and the highest lows within these sections? Considering that the 20 days starts exactly where this vertical line starts and ends with exactly where this vertical line ends. I will do the first one, and then you'll hopefully be able to identify the highest points within the 40 and 60 days. So right here, we can all agree that that's the highest point of this 20 days look back right there. And I think in the same way, you can all agree that this is the lowest point of the 20 days look back right there. So this now becomes my IPTA data range low. Well, technically it's not the 40 days low, it's the 20 days low. And in the same way, this becomes the 20 days high. Like so. And then you would also notice that in this case, we have a swing low and a swing high, creating the highs and the lows. Most of the time, well, sometimes it might not be the case, but most of the time it's going to be the case that the lowest point in the last 20 days and the highest point in the last 20 days are actually swing highs and swing lows. So already you can identify that this is one important level of liquidity, which is the IPTA data range highs and lows. This is the 20 days look back low. So let me give you a second to identify the highest point and the lowest point of the 40 days look back. For those that are actually participating, I hope you actually mentioned that this candle right here, the bullish one, is the highest point. If you mention this one right next to it or this one over here, you would also be correct because these are equal highs up here. So this becomes our highest point within the last 40 days. I'm drawing this out in price for a reason, and I'll explain that in a little bit. This also becomes the lowest point, and I'm hoping you did the same for the 60 days look back. So that's the lowest point, and the highest point is right there. So let's label this appropriately, and that's the 60 days look back high. So we got our 60 days look back low, 60 days look back highs, 40 days low, 40 days high, and 20 days low with 20 days high. So now, if without me explaining what a range is and considering where we opened up in the month, can you identify whether or not we are in premium or discount right now? Well, without as I said, without me teaching, I'll be hoping that you mention that we're in discount, because if we opened up there and we drop down below where we opened up, then we're technically cheaper than where we were at that point. And then the same happens with when we are above this blue line, we are more expensive than right here. So right now, I hope you also agree with me that we are in discount. The reason I draw these lines, the liquidity, because again, these are important levels of liquidity, but it's also important levels that the algorithm might refer to later in the future. Notice in this case, we took out the 60 days high and 40 days high at this point. Actually, this candle took it out, the one created on the 5th of April, and then this took it out even better and closed above it. So now you would think, okay, well, we've taken the liquidity here and the liquidity here. Do we need to really pay attention to it again? Yes, we do need to pay attention to it again, because notice when price traded down into discount, we are actually rejecting away from that 40 days high. We literally touched it and bounced off of it. Now possibly going back to the premium, which is like the 20 days high, for example, or the buy side liquidity all the way that side. So we are this is basically how I read price, from liquidity to liquidity. But this is just one example of a type of liquidity, which is the IPTA data range highs and lows. The next type of liquidity that I wanted to teach would be intra-day or intra-session based liquidity. I'm going to try and paste in the times that I focus on to draw out my liquidity, my highs and lows within a session or within an intraday sort of situation. But we should also notice that time is fractal the same way that price is. Somebody can be making profit by trading on the 1 minute chart, monitoring each candle, while I could be trading on the 15 minutes chart, waiting for each 15 minutes time frame to happen before I take any executions. But these are the sessions on my chart. We got the 7 p.m, we got the midnight, 8 a.m, 1 p.m, and 7 p.m. again. This is obviously all on New York local time. If your time is not on New York local time, just click on this on TradingView, then select New York there. It's going to synchronize to the daylight savings as well and everything in between. So let's try and plot this out for yesterday's price. Let's see where Sunday starts. Okay, Friday ends at that point there. We want to draw out the 7 p.m. price. I'm using vertical lines to make it easy to see the sessions the same way that we did with the IPTA data range. So we draw out the 7 p.m. price, which is all the way there. Looking below, you can see my time, 7 p.m. The next one would be midnight price, which is there. Next one is 8 a.m, which is there. And the next one is 1 p.m, which is there. Then the last one is 7 p.m. again, which is there. So to explain what this means, this line from 7 p.m. here till midnight is the Asia session. This one from midnight all the way till 8 a.m. is the London session, which is the longest session in the day, and you can see that with how wide it is. And then this session from 8 a.m. all the way till 1 p.m. is the New York AM session. This is the AM session of New York. And then from 1 p.m. technically till 4, the market closes at this point. Market closes at 4 p.m, but it's still technically part of New York AM. I mean New York PM session, but this entire region I consider it as Asia personally, because we get mostly consolidative price action. We don't get a lot of dynamic movement to the upside or downside, and you can see that the price chart literally just stayed sideways all through the Asia session. It's not really Asia, but if you want to be very technical about it, the price will close here at 4 p.m, then we move into Asia and start the day again from 7 p.m. again all the way till midnight. So here you could almost call it a dead zone. Let's put it that way. Let's drag this aside. You could almost call this a dead zone because between 4 p.m. till 7, nothing is really happening most of the time. It's just different brokers opening spreads and trying to resynchronize with whatever price they want to decide. So here I would call it a dead zone because nothing really happens. And then the Asia session starts again here at 7 p.m. all the way till midnight again. So that's our Asia session. So let's label these sessions appropriately again. So now that I've labeled it, we can see that this is the Asia session from when the market opened on Sunday. We can see this is the London session. That's the New York AM session, New York PM session, and this is our dead zone where nothing really happens. Well, not all the time, but let's just consider it as nothing really happens here. Then we got the Asia session again. And now obviously we are currently in the New York's and the London kill zone or London session. So let's do the same thing that we did before with the highs and lows. Looking at the Asia session from when the markets opened, this is one of those instances where I say that the high within the session may not be a swing high or a swing low. It may just be a high. For example, this high right here. When the session started, this was the highest it ever was at that point. Even though this here is the swing high, but you can see this is outside of the session. This is the previous session. So this technically right now is the highest point in the session. So this would be our Asia session high. And in the same way, you can agree with me that even though this is the swing low, this is our lowest point within the session. So this becomes our Asia session low. And doing the same for the London session, we can agree that this swing low is the London session low, and that's the London session high at that point. Again, I'm looking within the line, within the parameters that we've drawn out for ourselves. That's the London session high right there. And I think we can do the same for the New York AM and New York PM. And you can obviously see that the New York PM session doesn't usually move too much, along with the dead zone. And then Asia starts the dynamic moves again, going to London, which also has high movement, and New York, which also has the same. So let's mark out our Asia session highs and lows, London and New York. Okay, and that's about it. So let's look at the sessions once more. So now that we have an important high, and we could possibly even point out this swing high over there as a liquidity level, we could watch out to see how price may react at these specific levels. So let's say you are watching during you're watching the entirety of Asia form, and you waited until a London session happened. You see at this point we actually swept the London session low. We basically took liquidity at that point. We swept the lows, and now we may be able to realistically expect price to go to the opposite liquidity or opposite liquidity levels. Notice that during the Asia session we created this swing high there. We also created another swing high there. We also created another swing high there and another swing high there. But remember, this was where the argument came in on what swing high do we consider most important and which one is price likely going to head to. Well, it could head to all of them, but in this case we found one important one, which is the Asia session high, a session based liquidity. So we are probably looking for that Asia session high to be swept, and you can see that price gradually eventually went back to the Asia session high. So that's how I look at liquidity when it comes to sessions. We will eventually come to how do we trade this? How do we know whether or not price is going to go to the opposite liquidity? Does it happen all the time? If that was the case, why are people not constantly or consistently profitable? Well, there is a lot of complexities or nuances that has to be covered at a later episode. But as for now, I'm just showing what liquidity is and how to identify session-based liquidity, IPTA data range liquidity, and of course other time-based liquidity levels. So let's look at the London session high. We can see the London high was created at this point. We traded lower. Then during the New York session, the New York AM session, we can see we wiped the liquidity, we swept the London session high. And at this point, what do we expect? Well, we have all these swing lows. We have this swing low there, we have the swing low there, we have this swing low here and there, and of course the London session low. But realistically, what's the most important liquidity level in this case? Well, the London session low, which is the opposite liquidity, right? So we swept the highs, and now we expect us to go to the low, and we see exactly at that point by barely taking it, but we can see it did take it. Looking at the line, the difference between the two lines, we did end up sweeping that liquidity, which is the session low from London. So swept the lows, and now we are going back into the range. When I say range, again, I said I'll hint throughout this series what a range is and whether or not, how to know whether or not we're in premium or discount. When I say range, I basically mean the high to the low. So in this case, if I'm mentioning the New York AM session range, I basically say measure. I'm basically saying measure from the high of the New York session to the low of the New York session, and we can see this is the range. The 50% or the halfway point is exactly at that point. And something to note about the ranges now, for those that are actually writing notes, is that price has tendencies of going back to the 50% of any range. So obviously the same applies with the IPTA data range. So if you look at the 20 days high to the 20 days low, price has tendency to coming back to the 50%. And guess what? Measuring the 20 days low to the 20 days high, where do we see the 50%? Exactly at that point. And look what price did. It came back exactly to the 50%, give us a little bit of discounted price, and now we can look to go up again back to premium. So here in this example, we're in the discount of the month because we're below the EQ line, and we're in discount of the 20 days range, the 20 days dealing range, which is the green line there, the 50%. So anything below the 50% is discount, anything above the 50% is premium, it's expensive. So we have a range there. 90% of the time we're gonna get price heading back to the equilibrium of any range, and we see price eventually comes back to the 50% right there. And this happened during the Asia session. So this is essentially what I mean when I'm talking about session-based liquidity. Of course, the same as we just did with the IPTA data range applies with here. So we do have opening prices. So for example, the London session opened up at midnight. The opening price is right there. And that opening price for me is critical because that's how you know whether or not we are in discount or premium for the day. If I can just find my midnight opening price there. So right there, midnight price tells us we went cheap for the day because we opened at midnight, and then we went expensive, and because we're expensive we try to come back down to equilibrium. So us coming back down to the midnight price, which is our EQ level, is actually an easy draw on liquidity. The second time to note is the 2 a.m. time, but this is all on openings. This is not important for this video, but this line for me would be important because that's the opening price for the London session. That's the kill zone opening price. I don't actually have my 2 a.m. opening price, but we're just gonna use the 1330 there. So I would normally be drawing out my 2 o'clock opening price because this is the time I start looking for a liquidity that could be taken or an opposing liquidity that we could be hunting. So of course that was not labeled appropriately, but yeah. So yeah, this is basically session-based liquidity, and that was IPTA data range liquidity. The other type of liquidity that I wanted to show was the other time-based ones, like the previous day highs and lows, but those are very easy to identify, and I'll round up the video actually with that. we can obviously see that the Monday's range in this same example started at midnight there. Obviously that's Monday midnight, and we ended on Tuesday midnight, which is right there. So if I asked you to identify the previous daily highs and the previous daily low, where would you identify? Well, hopefully you would be able to tell me that that's the high of the day and that's the low. Well, technically this is the low of the day. It's literally as simple as that. The same applies with the weekly range. If I was looking at the 4-hour chart, say for example, and I asked you to show me the previous week's low and the previous week's high, hopefully you'd be able to draw out something like this from Friday's closing, and then go back all the way to Monday, which is Sunday's opening is actually right there. Let's look at it from the 2-hour chart. So if I asked you to show me the highest point and lowest point of the previous week, I hope you'd be able to say that that's the previous weekly high. I know it happened literally as we closed, but that is the high of the week, and the previous week low is right there. So it's as simple as that. Liquidity to liquidity. We sweep the highs, we expect to go to the lows. Within a session, we sweep the highs, we expect to go to the lows. Within the IPTA data range, we sweep the highs and expect to go to the lows. So in this case, we've swept the lows, not the low of the 20 days low. Obviously, the likelihood of that happening is high. We could possibly just see a sweep of these highs, which we did here, and now we could possibly be coming down for this 60 days and 40 days low. Very possible, but I'm looking intra-week perspective and intra-month, considering, and a few other things of course, but considering that we are now in discount for the month, I'm expecting us to come back into premium at least. And even if we want to go back down again, we might just sweep these highs and then come back down for these lows later on. So yeah, I hope that was insightful. If you do have questions, of course the Telegram group is in the description below. Do not hesitate to ask anything you may have in mind, and I will be covering inefficiencies in the next video. So for now, stay safe, look after those you love, and good trading.